Hello, everyone. My name is Zach Gast. I'm the Global Head of Research and Analytics with CFRA. I'd like to welcome you to today's webinar on our stars and portfolio performance, a review of what worked and what needs improvement. Before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we'll do our very best to answer as many of those questions as we can. During today's session, my colleagues Lindsay Bell, Sam Stovall, and I will review CFRA's stock and model portfolio performance for 2018 and methodology and process enhancements to continually improve performance. Lindsay Bell, for those of you who don't know, is an investment strategist for CFRA who's well known for her market observations and sector opinions that are expressed in her Sector Intellect articles on CFRA's MarketScope Advisor platform. Lindsay works with the CFRA team to determine appropriate asset class allocation and equity sector level weightings, and she participates in projecting the firm's 12-month S&P 500 price target. Sam Stovall, who most of you should know, serves as an analyst, publisher, and communicator of CFRA's outlooks for the economy, market, and sectors. Sam is the chairman of the CFRA Investment Policy Committee, where he focuses on market history and valuations, as well as industry momentum strategies. Okay, so on the agenda for today, what we'd like to do is go over a little bit our STARS methodology, as well as performance for 2018. And then we'd like to dive into some of our model portfolios, which we've selected. This isn't the entire group, but some, as well as a review of the CFRA Stovall seasonal rotation strategy in 2018. So beginning, we wanted to start with a description of CFRA's process. And the key thing to note here is we are working at two levels. So Sam and Lindsay are our strategists, and the analysts work in close coordination with Sam and Lindsay on bringing together a bottom-up analysis of companies with the Investment Policy Committee's views on which asset allocation strategies are going to work best, so that those things work together through time. On the next slide, we'll go into a little bit more detail on our equity research methodology, which is the bottoms-up analysis that leads to our star ratings. We've changed a few things this year, and those were fully implemented in the back half of the year. So I think one of the keys for CFRA is we have a phenomenal team of analysts together, great industry and sub-industry outlooks. And so that process is the first pillar of what we do. We review public information, we look at key external factors, and then we develop an industry outlook. Because one of the things we've talked about consistently is if you get the sector call right, that's the majority of your work for stock analysis. The other part of the work, which remains important, is our second pillar. And this is where we've added a lot this year around company analysis. So we continue to review public information and do bottom-up fundamental work. But what we've added is a forensic accounting review to try and minimize downside risk on the stocks we analyze, flag those, and make sure we're not recommending them. All of that leads into our financial forecasts, which we use to establish company value, and those determine and drive our STARS recommendation. For those of you that don't know, we have a proprietary 5-tier system rating from strong sell, which is 1 star, to a strong buy, which is 5 star. And we're guided by target prices relative to the applicable index, but this is an analyst-driven process with peer review. Okay, with that out of the way, let's go ahead and talk a little bit about our STARS. So next slide, please. Okay. Let's talk about what we're working on here, which is we are operating in an environment for 2018, which was fairly difficult. The first half of the year was a very strong market in general, followed by a general weakening in the back half. And you can see that in some of the data we present here for life to date. Those declines overall produced a decline of 8.6% for the market. The way we measure our performance of our stars portfolio is we do so on an equal weight basis. We don't want to use market cap and have the largest companies skew the performance overall. We also rebalance our positions daily so that large movers don't influence the back half of the year as well. So with that sort of side note out of the way, it's time to walk through some of the numbers from 2018. And what you'll notice from this slide is that these numbers are actually through January 31st, 2019. This was intentional. And what we want to demonstrate is that we're committed to transparency and that these numbers are being updated monthly. So these represent the figures you would see today going to our website. They're typically up within 1 week of the end of the month, and you can see the performance of each of our regions and of all our model portfolios in real time. So let's talk a little bit about performance for 2018, and I'll start with the U.S. region, which is where most of the customers on this call are probably most interested. So in the context of that difficult year, our 5 stars returned on a total return basis negative 17.5% in 2018. The 4 stars returned negative 12%. The 2 stars returned negative 15.4%, and the 1 stars returned negative 2%. All that is relative to the benchmark return of negative 8.6%, so a down market in general. While we wanted to strive for better performance in 2018, we are seeing improvement. We saw improvement in the back half of the year. It's important to note that. And we continue to have an incredibly strong track record over the long term. So at this point, our 10-year returns average 14.7% for 5 stars in the U.S., 17.1% for 4 stars, negative or positive 10.9% for 2 stars, and 13.7% for 1 stars. All of that is relative to the benchmark return of 13.8%. So we are seeing the model performance we would like to see over the long term, as well as in the back half of 2018. So we're very excited for what we've been able to implement to improve performance, and that should continue into 2019. If you go to the next slide, you can review a little bit our European performance. Again, all these numbers on the slide are through January 2019. For Europe, though, just for 2018, our 5 stars returned negative 3.1%. Our 4 stars returned negative 14.9%. The benchmark returned negative 11.4%. And our 2 stars returned negative 3.7%, with 1 stars being at negative 28.3. Again, if you look back, and I won't go through the full long-term results for each of these, we are seeing great long-term performance. The story in Europe was a little bit different, where performance actually deteriorated into the last 2 months of the year, but has reasserted itself into this year. If we go to the next slide, we can take a look at Asia. For Asia, our 5 stars returned negative 16.3%, 4 stars negative 13.2%. The benchmark was down 17.2%, so both of those categories outperformed. Our 2 stars were down negative 14.8%, and our 1 stars were down negative 45.2%. So very strong performance in Asia in picking winners versus losers and helping set us apart. We do relative to the benchmark, so that is the type of performance we're looking for there. And with that, we'll actually take a look also at our performance. So one of the keys, and I mentioned this, was the performance improved in the back half of the year. And what we like to do is compare ourselves against our benchmarks and what we're looking to do, but also relative to other research providers. Some of you may know Investars. They're a firm that ranks fundamental research providers using their buy and sell recommendations. We've excerpted here just the 6-month performance, but we'd encourage people to go look at the 3- and 5-year performance as well, and compared ourselves against all providers that work on more than 900 stocks as of January 23rd, 2019, which is when we pulled the information. And you can see that CFRA's performance outpaces all other providers on the InvestStar website over that 6-month period, as well as over the 3-month period. So do take a look at those. Those are available on a daily basis from InvestStars. We've just taken the data we took, limiting it to firms with global coverage. And with that, we'll proceed to the next slide and hand it over to Lindsay.
Thanks, Zach. I will get into the details of how the models are created and managed. Going to the first slide here, we talk about it really all starts with the Investment Policy Committee, IPC for short. Sam Stovall, who's on the call as well, he's the head of the Investment Policy Committee. He's the Chief Investment Officer here at CFRA. There's 5 of us that make up the committee. I am one of them. It's led by the strategy team. And just quickly, we come up with the S&P 500 price target, what our asset allocation is going to be for the year and the year ahead, and we come up with equity sector weightings. And this chart, the pie chart, shows you what the asset allocation is, and the table shows you the S&P 500 11 sectors broken down by our recommendations. Right now, we're overweight energy, technology, and utilities. And with that, that is what the portfolio management team, which I'm going to get into on the next slide, they will use that as a base for determining the allocation to different sectors within the portfolios that are on Market Scope Advisor. So the Portfolio Management Committee, which is separate from the Investment Policy Committee, is a 10-member committee led by myself with the investment strategy team. There are 8 equity research analysts, and this year new to the team are 2 forensic accounting analysts. We added them in the past year to really add a deeper level of analysis to these portfolios, kind of as a sort of a safeguard risk with regards to risk to the downside. Within that 10-member committee, we have 4 people that are assigned as portfolio managers of 4 of the portfolios that are really qualitatively driven by analysts, really. Those are the portfolios that we discuss in detail with every single meeting that we have, which occurs on a monthly basis. The second half of this slide, I talk about the stock selection process for those portfolios. Like I said, it really starts with what the Investment Policy Committee suggests from a sector perspective. But since we're not creating portfolios brand new every time we meet, we're working with what we have. We just use that sector selection as a guide when we review the portfolios. The second thing that is a key component of many of these portfolios is the star rankings by the analyst, which Zach went over. Most of these portfolios have to have a 4 or 5-star ranking, which is a buy or strong buy to enter the portfolio. But these couple bullets here talk about how we really go through the process before we meet on a monthly basis, or if a portfolio manager managing one of these portfolios decides that a stock has run significantly and we want to take our gains because he or she thinks there might be better opportunities somewhere else, or maybe a stock was downgraded to a hold from a 3-star, basically from a 4 or 5-star. That could be a catalyst for us to make a change. Maybe a stock just hasn't been performing as well as we thought, and so we want to make a change then. What happens is the portfolio manager comes up with a list of new replacement ideas, vets them with the individual company analyst that covers those stocks. Once they finalize their list of 2 to 3 or 4 names, then the portfolio manager reviews those with the forensic accounting team, like I said, for that deeper level of analysis. And then once that vetting process is done, they present their ideas to the committee and their rationale for removing one stock and replacing it for another option. A vote is taken. We need a simple majority rule to make the change. And I should note that while a lot of these changes occur after our monthly meetings, if a change needs to be made, we can have that discussion over email and we certainly do that. All changes are made official on Monday after the close, but what we do is if you are a subscriber to MarketScope Advisor and you are following these portfolios, you will get an email on Friday at some point after the close about a change that is expected to be made after the close on Monday. So you'll be given the details of what stock's being sold and which one will be bought to replace it. And that's how our clients are notified. So taking one step deeper into the portfolios, there's 15 of them overall on the MarketScope Advisor platform. 4 of them, like I said, are really actively managed by the Portfolio Management Committee, but we keep an eye on all 15 of them. 10 of them are really rules-based and quantitatively driven. 3 of them are ETF portfolios. I should note all the portfolios on MarketScope Advisor are either equity or ETF portfolios, so we don't have any bond portfolios. There is, so you're saying 4 plus 10 is 14, not 15. You say you have 15 portfolios. The 5th one is the Focus Stock of the Week, which also we have a member of the Portfolio Management Committee vetting new ideas to add to that portfolio. Basically, a new stock is added every week that has a 5-star ranking. Again, that means strong buy. And that stock will stay in that portfolio for 6 months before falling off. So every week a new one is added to that portfolio. We have Power Picks. We have Industry Momentum, which is one of the portfolios Sam keeps up to date. And then there's the Investing Ideas, which is basically based on what the Investment Policy Committee sector recommendations are. So whatever we have buy-ons, we have ETFs for each of those sectors in that portfolio. So right now, that is tech, utilities, and energy. So we have a lot of different portfolios to talk about, but we're going to focus really on these ones that the analysts are really, rolled their sleeves up and dive deeply into them. These portfolios range in age from 9 to 24 years. Some of them have been around for quite a long time. The number of holdings ranges depending on what the goals and outcomes are expected for the portfolios, but most of them have 15 holdings. The top 10 obviously only has 10. And so that's just kind of a quick overview of what the portfolios look like. On the next slide here, we have what the 10-year price performance has been for all 15 of the portfolios that I just mentioned. And you can see on an annualized basis, most of these portfolios have been able to return double-digit growth to people who have invested in these. Most of the each one of these portfolios has its own benchmark, but most of them do use the S&P 500 Equal Weight Index as its benchmark. I'll get into that in the next couple of slides, but this is pretty good performance. I think we can all agree over the long term, especially when you think about on average, you see the S&P 500 up 8% on an annual basis. Let's get into the details of some of these portfolios. High quality capital appreciation. Really quick, I mean, this is a portfolio that performs, as you can see from this longer term chart, it performs mostly in line with the benchmark. And the goal of this portfolio, basically to enter the portfolio, not only must the stock have a 4 or 5 star ranking, but they must also have a high quality a quality ranking of A- or better. And that comes from S&P Global Market Intelligence. And what that basically means is that if you have a high quality ranking, you have an above average 10-year history of earnings growth and dividend growth and stability. And what S&P says about these quality rankings is that they found over the longer term that stocks with the best quality rankings post higher profit margins, higher return on capital, and stronger cash flows, and you also get less volatility. So this is kind of a way for you to manage your risk both to the downside and upside. So that's why you see this perform pretty closely in line with its benchmark, the Equal Weight 500 over the long term. Over a 3- and 5-year basis, this portfolio has outperformed its benchmark by 40 basis points and 220 basis points on average. So So, for example, on the 5-year basis point, or 5-year period, you've seen this portfolio increase 9.2% versus the benchmark up 7% on an annualized basis. So let's get into 2018. As you can see, again, just like over the longer term, this portfolio really tracked the market throughout last year, although you did see in the last quarter of the year that this was a portfolio that was able to outperform the market. In the final quarter, this portfolio declined 13% versus the benchmark's 4% decline. At the end of the year, we added Gentex and Dollar General in a way to diversify this portfolio into more defensive names. But, you know, like I said, it followed the track record of the S&P 500 for the majority of the year. This portfolio has a decent exposure to healthcare, and you saw Thermo Fisher is a stock in the portfolio, and Church & Dwight. They both did really well for us in the year in this portfolio. Well, on the downside, though, there were a couple stocks that didn't perform as well as we had expected. IBM being the biggest offender, which was off 31% since its addition to the portfolio on January 16th of 2018. There was a lot of questions around its acquisition of Red Hat. Once we found clarity on this deal, you saw the performance of this stock turn around in 2019. Some of the other underperformers in 2019 also are up significantly on a year-to-date basis this year. So East West Bancorp, United Technologies are two other stocks that didn't perform too well last year, and they're both up, you know, above 20% on a year-to-date basis. Small mid-cap growth, of course, the goal here is to get exposure to that asset class of small mid-cap stocks. $7 billion less market cap to get into this portfolio. You have to have a 4- and 5-star ranking. There's more volatility related to this, and there's more risk inherent in this portfolio, just given the market cap focus that it has. The benchmark here is the equal weight S&P 400. And this is a portfolio that has outperformed its benchmark 53% of the time since inception. It's up 11.5% on an annualized basis over that period versus 9.4% for the benchmark. So it's been a decent performer, especially you can see in more recent time from 2013 on. Looking at 2018, like I said, there's more volatility associated with this index. And if you look at this portfolio, it declined 19.3% in 2018 versus the benchmark down almost 12%. You see at the first half of the year, there's tight correlation with this benchmark, and the second half of the year is where the underperformance really came in. We saw tech was a positive for this portfolio. Believe it or not, throughout most of last year, we had some semiconductor stocks in here that we sold out. We made some good timing calls on that. Integrated the device technology and Semtech were two of those names. On the downside, however, though, we had exposure to some financial names that didn't do so well. Synovius, Stifel Financial are two of those names. First Horizon, again, down 30% or more for all those names in the period. We sold out of Synovius, but we still own the other two, and they're up between 18 to 30% on a year-to-date basis. And so this is a portfolio that's really benefiting from stocks that got beat up last year are doing well this year. Turning to the top 10 portfolio over the last couple years, this is a portfolio that's underperformed. Like I said, this is a smaller selection of stocks. There's 10 constituents. There's more turnover in this because this is when we think about this portfolio, we think about it as being our 10 best stock idea. So we want to keep it at 5-star rankings, all 10 stocks within this portfolio to have that 5-star ranking. And because of that movement, you see more turnover within here. And we can, by the way, this is a portfolio we can make changes at any time, given that need to keep it at such a high profile stocks. Like I said earlier, we usually trade we notify you Friday and we make the trade on Monday. Top 10 we can trade at any time. 2018, this was a poor performer. The stock was down over 20%, 20.5% for 2018, while the benchmark was down at 8.2%. We did have some healthcare exposure here, so that was Thermo Fisher was a benefit. We also owned Disney. It was up 2% for the year, but when your benchmark's down 8%, that's pretty good. But some of our tech exposure really got hit with the downturn in technology stocks in the latter part of the year. DXC was one of those stocks. It was down 41%. We did remove it from the portfolio on December 17th. It's, a digital IT services and consultant company. You've seen management exits there, contract losses, the weakness in the Americas region. That Alibaba was another one. And again, this was one that we had exposure to the financial sector, and that hurt. So as the new year is starting off, we're looking at new stocks to get into this portfolio and kind of start a new clean slate. Finally, the total return portfolio. The goal here is long-term total return. The key for this portfolio is really what the dividend yield is. We want to see a dividend yield greater than or equal to the S&P 500. It can't have been cut within the last 5 years. It must be secure. Again, 4 or 5 stars to get in it. This, on a longer-term basis, is the best performing of these portfolios that we're viewing today, beating the benchmark 67% of the time. The last 3 years, the outperformance has been very good, and as well as the last 5 years, really. Looking at 2018, though, this was another portfolio that was not immune to the downturn in the market for the year, but down 9.1% isn't so bad versus down 8.2%. This dividend, lower volatility, higher quality stocks, really, if you think about it from a dividend perspective, you're going to have more high quality stocks if they're paying dividends. Helps it perform a little bit better than some of the others. The biggest mistake we made in this portfolio is Dow DuPont. Huge decline on the year, but going into, they just reported earnings. It was a little bit of a disappointment. The analyst that actually is the portfolio manager on this portfolio covers the stock, and he really believes in what they can do in 2019. Volume and price increases are coming. Cost control efforts are in place. He expects productivity and mix shifts to benefit. And by the way, cash flow was up 25% quarter over quarter in the fourth quarter. So that means the dividend is secure within that stock. We'll be keeping an eye on it as the next couple months unfold. Finally, I'll pass that to Sam. I probably took more time than I should have to talk about his seasonal rotation portfolio.
Thank you, Lindsay. I'll forgive you. Yes, this is the seasonal rotation strategy, which was first introduced in my book, The 7 Rules of Wall Street, that came out in 2009. Essentially, like whitewater rafting, you let the market take you where it wants to go. If we go to the next slide, we can discuss a little more about what is the seasonal rotation strategy and how it has performed. Basically, what we find is that we have 2 6-month periods of the year in which the market does exceptionally well and alternately does quite poorly. November through April, the S&P 500 has risen quite strongly, up almost 7% on average since World War II, whereas in the May through October period, the S&P has gained only about 1.4% on average. Hence, we've heard the old saying of sell in May and go away. But actually, since the market has risen in 63% of all calendar years in that May through October period, I find that it's better to rotate than it is to retreat. So what this strategy does is goes into the defensive sectors from May through October, and then goes into the cyclical sectors from November through April. So it really stays in the S&P all year long. But as we see in this chart right now, going back to 1990, which is as far back as S&P Dow Jones Indices has sector level data, while the S&P was up only 0.7% on average May through October. Let's go back one slide, please. what we find is that the consumer staples and healthcare sectors were up an average 4.5%. Also, the average of these two defensive sectors beat the market about 2 out of every 3 years. Yet in the cyclical 6 months of the year, as seen in the blue bar, while the S&P was up 7% on average since 1990, the cyclical consumer discretionary, industrials, IT, and materials sectors were up an average of 9.3%, also outperforming on a batting average basis. Now, if we go to the next slide, we can see that it's a very simple process that at the end of April, investors would buy, as seen in the blue, the defensive groups, 50% exposure to consumer staples, 50% exposure to healthcare, and then hold on to it until October 31st of that same calendar year. At that point, the investor would sell the defensive groups and then buy in 25% exposures to consumer discretionary, industrials, materials, and tech. Yet investors say, well, wait a minute, I don't want to have to set an alarm to remind myself to do this at the end of October. Plus, if I were to be doing this, it would be a 6-month ordinary income return, which is taxed less friendly than a capital gains return. Do you have any ideas or chances to turn this into an ETF? Let's go to the next slide. And what we show is the performance of these different strategies, whether you're looking at the cap-weighted 500, the equal weight 500, which has the orange arrow to the left, the small cap 600, and the global 1200. These are custom index performance data provided to us by S&P Dow Jones indices. And what we see is that in December, while it was a challenging period for the market as a whole, the S&P equal weight 500 was down 9.7%. The seasonal rotation equal weight eked out an outperformance by 20 basis points of minus 9.5%. For all of 2018, while the market was off 7.6%, this strategy was down 2.4% on a total return basis. And since this custom index's inception in April of 1990, the compound annual growth rate of 17.1 exceeded that of 11% for the equal weight 500. It also beat the benchmark in 2018, as it has done in essentially 3 out of every 4 years going back to 1990, and has done so with a lower overall standard deviation. Year to date through last night, the seasonal rotation index is up 14.3%, and the equal weight 500 up 13.6%. To learn more about the ETF, please go to paceretfs.com. They can teach you about how Pacer has embraced the custom index and turned it into an actual ETF. So essentially, by letting the market take you where it wants to go, by embracing a rules-based approach and not bailing out of the cyclical sectors in December, as an emotional strategy would have done, it allowed you to stick with those stocks that then recovered, as Lindsay had said, as we have entered this new year. So with that, I believe that's my last slide. We can all examine the disclosure statements and then open it up for Q&A.
Thanks, Sam and Lindsay. Really appreciate you sharing all of that. Now's time when we can turn to Q&A, and we have a ton of questions coming in. Unfortunately, we're not going to be able to get to all of them. We were hoping to make this through in half an hour, and we've already crossed that line. So we'll stick to 2 questions and then promise to get back to everyone on their questions after the call if we haven't done so here. So the first question that came in was, the 3 stars rated stocks appear to have outperformed the benchmark over time. That is true, and there are 2 basic reasons for that. One is that with any of these categories, we could have selections that slightly outperform or underperform. That's the purpose of the 4, 5, 1, and 2 stars, not the 3 stars. But there will always be some tracking error, even if we get the calls as close to correctly as we can. The second reason is we are using the S&P 500 benchmark equal weight as our benchmark, but it's important to remember that in North America, we actually cover 1,100 stocks. So the performance of those 1,100 stocks could differ from the benchmark that we're using, which is the 500. What we're hoping to do for everyone to correct that is, in addition to providing the standard benchmark returns, which people ask for and want, understandably, we're going to also try to provide information on what the performance of the entire universe of companies we cover was, which is the true benchmark of how well are we picking buys versus sells. So hopefully that answers your question. The second question that came in that we're going to be able to answer noted that Pacer offers an ETF that tracks the performance of one of SAM's and CFRA's seasonal rotation strategies. Is there an ETF that tracks the performance of, in particular, the high-quality capital appreciation portfolio? The answer to that right now is no. We've chosen not to do asset management directly, and we have not set up a relationship with a provider to do that for us at this point. But if you as clients are interested in that, that is definitely something we'd be excited to hear from people and determine if that's something, a direction we should move in the future. Okay, right now it is 11:40, so what I wanted to do is move to wrap up. As we move to do that, I wanted to mention our next couple webinars. We hope you'll join us on Tuesday, March 5th for how to sort through the growing ETF universe. During that session, CFRA's Director of ETF and Mutual Fund Research, Todd Rosenbluth, will highlight some key do's and don'ts when choosing and purchasing an ETF and provide several case studies with a lower priced or larger ETF performed quite differently from similar sounding peers. During that session, you'll also hear from CFRA's leading equity analysts who will discuss the fundamentals of the sectors and industries behind some of these funds, including technology and industrial sectors. A link to register for both of these sessions will be sent to you this afternoon, along with a replay of today's session. So on behalf of the team at CFRA, we'd like to thank you for joining us today. Within the next day or so, you'll receive a note from us with a link to the replay and slides from today's session. In the meantime, if you should have any questions, please don't hesitate to contact any of us or cservices@cfraresearch.com. Thank you for participating.